Hey there, YouTube family. Well, as we expected, the markets are falling hard right now after the Fed's announcement. And we've yet to get to his speech, but I don't think, to be honest with you, that he is going to offer up anything else other than hawkishness right now. And if these markets rallied, they would be confused. I'm going to play a quick clip and a reaction from the former Fed on CNBC to the rate hikes that we just got.
Stocks are falling just a bit, well, more than just a bit right now, 272 points on the Dow, as you see there, after we've heard from the Fed, decision to raise interest rates by 0.75 of a point. Yields have been spiking, the two-year yield now at its highest level since 2007. It is above 4%, as you see there, really close to 4.1%. The decision sounded a little more hawkish. As Steve Leisman put it, he out-hawked the hawks. Long-term rates above 4.25% by year end. With us now, Frederick Mishkin, former Federal Reserve Governor. Mr. Mishkin, welcome. Good to see you. You believe that we got here because of policy mistakes made by the Federal Reserve and the fact that they had to play catch-up. Are they playing catch-up too hard right now?
No,
are they doing the right thing?
Been very critical of the Fed for well over a year on CNBC,
yes,
because I think they needed to do much more. And in fact, had an op-ed in the Financial Times in January saying that their policy framework was flawed. But I had a recent op-ed, and the Fed has now turned the ship around. It's doing exactly what they need to be doing. That they have to be tough. That their rhetoric is now exactly where it needs to be. The good news is that inflation expectations have responded to the Fed's toughness and actually have receded somewhat, which is very good news. The problem here is that the likelihood of a recession is very high. Soft landings are just not possible or very, very unlikely in situations like this where you've made some mistakes, you've gotten behind the curve, and now you got to do catch up. And what that means is that the Fed's got to keep on being tough, and a recession is very likely to occur, and there's going to be a lot of pressure on the Fed to ease off. In fact, the markets had been thinking that once the economy starts to slow down a lot, a recession occurs, that the Fed will back off. That would be a huge mistake. And I just had an op-ed in the Financial Times about a week ago saying that people don't remember that Volcker, the tough guy Volcker, actually blinked in 1980. And as a result, the Fed had to raise rates by much more than they otherwise would have. We had an extremely severe recession. And so if the Fed basically blinks and is not doing what it's doing now, which is talking tough and convincing markets that they mean business, then the problem will be that they'll actually have to raise rates by more, and a more severe recession would result.
Okay, obviously he said very clearly that he had been a big critic of this Fed over the last year and a half, as he had been calling for interest rate hikes that he just didn't see coming. And he also said what we said yesterday is that the Fed is behind and he is desperately working to catch up. And we know that because we've had 375 unprecedented basis points, one after the other. So I guess we can kiss our soft landing or our Goldilocks environment goodbye, because the Fed is on a fast course to get the markets corrected, and the markets are going to have to price in that correction, which I think is going to take us to the downside. But I want to remind everybody that the markets, they don't just go straight down. They're going to vacillate. We're going to have a lot of volatility. The VIX play had some very profitable moments today, but we're going to see the markets are going to get oversold in certain areas, and then they're going to bounce. And so it's not as simple as just buying in today as the markets have fallen on maybe the SQQQ or puts and expecting them to be more profitable tomorrow. You want to try to ride a wave. I'm not a big surfer, but I actually do have family on the West Coast and in Hawaii, and I have been around the surf culture a lot. You just don't go and paddle out into the ocean and the wave doesn't catch you. You got to get to the wave. You got to get positioned into it correctly in front of it. You got to move fast, and you got to hope that you can stand up and ride it. And I don't think investing is terribly different. We don't know. We can't just get out there and assume that the markets are going to be crashing. We've got to get aligned in the right moment to take our position so that we can successfully ride it into profit. What I am most amazed at is what I pointed out to you guys yesterday. Even though I told you that we were absolutely looking at an extremely bullish dollar chart, I was still surprised to see how hard it pumped today. And I've said many times that when the dollar is pumping, the markets will be falling. I'm actually encouraged by how hard the dollar pumped. I want you guys to check this out. That's a monumental green candle. And it tells me that we're not just going to vacillate in a tight, compressed pattern for days on end. It tells me that these markets are moving and beginning to be decided with the dollar breakout. If the dollar peaks over the course of the next week, it could actually signal a nice pullback where it would allow the markets to rally forward. I also referenced the 10-year Treasury to you guys, and I want you to see how absolutely systematic this is moving up. And now it works inverse to the S&P 500. So I want to point out, US Treasury yield went up, the 10-year. You can see that the S&P went down, and we are steadily moving up. So we want to see this strong defined trend line. We want to see it break. And when it breaks, then we could imagine for a much longer sustained rally, not just a bear rally, but perhaps a bull rally. So this is going to be one of the indicators, as well as the dollar. When the dollar's not done moving up, this is a breakout. It's going to move up for a number of days more, which means the markets are going to pull down for a number of days more. We're going to try to find those right moments. There will be some relief moments in there. That's when you want to take a position on a short or on the SQQQ. I still get a lot of questions about which one does which. You go on the SQQQ when you think the markets are going to fall, and the SQQ will go up in value. So the TQQQ is for when we're bullish on the markets, and we can't be bullish right now. It's not to say we won't get some relief rallies. It's not to say that the market won't be oversold and we will pull back up for a little bit, but we can't think about going long on these markets while the markets are going to begin to price in what the Fed just did today, as well as what I'm expecting is going to be a hawkish Fed later today. As always, there's a lot of chatter over on MooMoo. That's where I connect with you guys, as well as the comment section here on YouTube. If you guys want to join me over there, open up an account, deposit $100, and you're going to get the opportunity for 15 free shares. But with $100, you're going to get a total of 6 tries at shares worth $2,000 each. But get that account, come over there and join us where we talk about what's going on in these markets, and I answer questions more specifically. You can find me on the YouTube comments as well as the MooMoo comments. I find that people who are connecting with me on MooMoo tend to enter more into dialogues because there's so much spam on YouTube that a lot of you, even when I respond to you, might not see those responses because you're thinking it might be spam. There's a link there for MooMoo where I'm doing my swing trading, and there's also a link for Webull where I do my value investing. Okay, so what does some of this mean? Well, it is really just the strongest confirmation of the fact that we are in a recession and we are moving towards a deeper recession. This dollar breakout and the Fed raising the interest rates is really going to have a big impact on the rest of the world. When the dollar is strong, it really messes up trade for Europe and China. They suffer to trade with us against such a strong dollar. It's like a massive headwind. Now, we already know that they're in a huge recession. I read an article this morning regarding Europe's inflation, and I don't want to misquote it, but it basically jumped from like 10%, and in some areas it jumped up to 45%. But whatever it did, it was a massive inflation jump came out for them today. They're in a lot of trouble. China's in trouble, and our dollar is making their situation more difficult. And the impact that's going to have on us is that we sell into those markets. We sell a ton of iPhones into those markets and Teslas and other products. And it's going to come back around and affect our earnings. We're going to see that, I believe, in November. And I believe that that's also why the Fed was pushing so hard with a third interest rate hike, is that he has to try to get ahead of those bad earnings, because he's going to have to, as I said yesterday, put his foot on the brake and take it off the gas. At the end of the day, the entire conversation is going to be about the terminal rate and the pivot, which we might get some insights when he speaks here shortly. That's it. That's all I've got for you guys today. Let me know what you guys traded. Hit the like, say hi in the comment section. Remember, this is not financial advice. There are scammers in the comment section. If you like the video, if you're learning something from these videos, then subscribe, hit that notification bell. I appreciate you all. I will see you all again soon, and in the comment section. Take care. Peace and blessings, my friends.